Okay, so chapter 9 is an interesting chapter. I kind of like the the perspective that it takes. It looks at a budget and says, is this really working for all cases? So if we look at variance analysis in general, we prepare a performance report and then we analyze the variances in that report, which raise questions. Some of those variances we're not worried about. Others we think are a problem. The ones that we think are a problem, we have to identify what's the root cause of that variance. Once we know the root cause, then we can come up with ideas or suggestions as to how to fix the problem. We take actions with some of those. We then go through another period of operations and we run another performance report. And we see whether or not the changes that we made actually made a difference in performance. Planning budgets are prepared for a single planned level of activity. So a planning budget is something, for instance, that I did for my entire 24-year career as a controller, right? Annual budgets. Performance evaluation is difficult when actual activity differs from plan. So as we looked at in chapter 8, a master budget, what did the master budget start with? It started with expected sales. So we did the budget based on a projected amount of sales. So characteristics of a flexible budget. The flexible budget works with any level of activity, not just the level of activity that's planned for. It shows costs that should have been incurred at the actual level of activity. It helps managers control costs. So we're going to go look at Larry's lawn service. Larry does lawns in a planned community where all lawns are approximately the same size, which is nice because it makes it easy to plan. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all of the lawns are similar in size, Larry felt the number of lawns mowed was his cost driver. So here's Larry's planning budget. Based on 500 lawns, which we're going to call Q, the revenue is going to be $75 times Q, the number of lawns. In this case, 500. So we're going to project $37,500 in revenue. Wages and salaries are going to have a fixed and a variable portion. So the fixed portion is $5,000. The variable portion is $30 times the number of lawns. Again, $30 times 500. So there's our wages and salaries. The formula for gasoline and supplies is $9 times the number of lawns. Equipment maintenance, 3 times the number of lawns. And then we get to our fixed expenses: office and shop utilities, office and shop rent, equipment depreciation, and insurance. So based on Larry's projections, his planned expenses are $32,500. The planned revenue is $37,500, so he has a net operating income of $5,000. Now here are Larry's actual results. He did 550 lawns. Revenue was $43,000, and so forth. So obviously we would expect, since he did 50 lawns more than the planning budget, that these numbers are all going to change. So when we look at the variances, and these are between actual and planning budget, there's a favorable revenue variance of $5,500. Again, because we did more lawns, we would expect to have a favorable variance there. We have an unfavorable variance here, and an unfavorable variance here. We have favorable variances, office shop utilities, and a unfavorable variance here in insurance. And overall, we have a $1,450 favorable variance. So we've got some favorables, we got unfavorables. Remember, favorable means we did better than the budget. Unfavorable means we did worse than the budget. Okay, so since these variances are unfavorable, Does that mean that Larry did a bad job of running the business? Well, we can't really say because the planning budget was based on 500 lawns. The actual results were 550. At this point, we cannot answer the question because the actual level is greater than planned. So the actual variable expenses are likely, obviously, to be higher. The relevant question here is how much of the cost variances are due to higher activity and how much are due to cost control. To answer the question, we need to flex the planning budget. And what that means is we're going to use the planning assumptions, but we're going to use the actual number of lawns, the actual rate of activity. So at the actual rate of 550, revenue should be 41,250. Wages and salaries should be 21,500, and so forth. So now we're looking at what the expenses should be, not the fixed, but the variable expenses based on the actual level of activity. That's what the flexible budget does. It takes the actual level of activity and then uses the planning budget assumptions. An activity variance arise solely because of the difference in activity level between flexible and planning budget. So here we have the planning budget at 500, the flexible budget at 550. So we have a favorable variance of $3,750 in revenue. That's a, excuse me, that's an activity variance. Again, wages and salaries has an unfavorable $1,500 variance. Gasoline and supplies, equipment maintenance, unfavorable variances. But again, those are solely because we did more lawns than we actually budgeted for. So we have a total in expenses, a total unfavorable variance of 2,100, but overall, because we had a favorable revenue variance, we have a net operating income favorable variance as well. So activity and revenue increased by 10%, right? Activity went up by 10% from 500 to 550. Revenue did the same thing, obviously, because it was based on the activity level. But what was the difference in net income, operating income? Much more than 10%. Now we're looking at what we're going to call revenue and spending variances because we're going to compare the actual results with the flexible budget. So these are both based on the same activity level. That's the key here. So we still have a favorable $1,750 revenue variance. We have an unfavorable wages and salaries, unfavorable in gas and supplies, favorable in equipment maintenance, and favorable in office and shop utilities. That's kind of odd, but... And then we have this one that has always bothered me. Why would you have a spending variance between the actual results and the flexible budget in insurance? Don't we just pay a premium and we're done with insurance for the year? This is kind of odd. Point being, we now have some money variances to look at. So now we're looking at everything. We have our activity variances, we have revenue and spending variances. So net operating income overall has an unfavorable revenue and spending variance. The flexible budget said we should have had 6650. The actual result was 6450. We have a favorable activity variance. And what they're showing here is the difference, this difference of $3,750. If you take 50 times 75, that's 3750. That's where that variance comes from. It's the activity variance. It's based on the fact that we did 50 more lawns. We have an unfavorable activity variance here. Why? Because the planning budget said 20,000, flexible budget is 21,500. This is 30. So we did 50 more lawns, 30 times 50, 1,500. So that's where that unfavorable variance comes from. On the revenue side, the difference between the actual and the flexible budget revenue, 1,750. Now, we really shouldn't have that, because if everything is working right, the actual results and the flexible budget should be the same at the same activity level. Performance reports are often prepared for cost centers. That was me for most of my career. I was running the accounting department. These reports should be prepared using the same principles discussed so far, but they're not going to have revenue. Although I argued that my department, using the financial information that we had, made recommendations that reduced expenses, which increased net income. So even though we weren't bringing in more revenue, we were increasing the bottom line anyway. Didn't buy it. More than one cost driver may be needed to adequately explain all of the costs in an organization. We looked at multiple cost drivers in another chapter. We're going to take a look at it again. Because the time required for edging and trimming is different for different lawns, Larry decided to add an additional cost driver, hours, for the time required for edging and trimming. So Larry estimated the additional hours and developed a new planning and flexible budget, including the second cost driver. So number of hours is H. The planning budget is getting an additional 100. So now revenues are going to be 75 times Q, the number of lawns, and $25 times H, the number of hours. So we're bumping up revenues to 40,000 with the second driver. Wages and salaries, we're taking 5,000 base, $29 times Q, the number of lawns, and $25 times the number of hours, for a total of 22,000. Gasoline and supplies, equipment and maintenance, same thing. We're adding the hours to the calculation. So those are the formulas for calculating those expenses. We still have the same fixed expenses. So based on the planning budget, revenue is going to be 40,000, expenses are going to be 34,300, and we'll have a net operating income of 5,700 bucks. Now going to the flexible budget, we're doing that 550 lawns that we had before, the actual number of lawns done. We're adding those hours in for the edging and trimming, and then running the formulas. So 75 times the number of lawns plus 25 times the hours, 2,500, will give us expected revenue of 43,750. Wages and salaries is going to be 23,450. Gasoline and supplies, $5,000. Equipment and maintenance, 1,300. And then, of course, our fixed expenses. So our total expenses under the flexible budget are 36,250, and our expected net operating income is 7,500 bucks. So you can see the big difference: 5,700 under the planning budget, 7,500 under the flexible budget. And here's our performance report with the multiple drivers. All right, so we've got 100 hours in the flexible budget, 100 hours here. The flexible budget gets the 550 actual lawns. And notice we're not using the actual number of hours in the flexible budget. We're using the planning budget hours. So we see an unfavorable revenue variance Flexible budget said it should have been 43,750. Revenue came in at 43. We have an activity variance, a favorable activity variance again between flexible and planning of $3,750. That's again going to be due to the fact that we're doing 50 additional lawns. We come down to the expenses. We have unfavorable activity variances for everything, but a favorable bottom line activity variance because we had 3,750 in revenue. Coming over to the revenue and spending variances. Now this is interesting, right? The unfavorable variance in revenue. That really shouldn't be. We need to, I would say, I need to look at that. Wages and salaries, $50 on 23.5, not a big deal. That's pretty much breaking even. $100 on gasoline and supplies, $50 on office. See, now this is looking more, and this is still here, and this is still bugging the heck out of me. So we have a net operating income variance unfavorable in revenue and spending of $1,150. So we do need to look at some things in here. And that's the end of chapter 9. This was a relatively short chapter, but I think flexible budgets is an interesting concept in that it does address the idea that if you have a planning budget set at a particular activity level and the actual activity is different, there has to be some way to create an apples to apples comparison. And the flexible budgeting does that. Have a great week. Thanks again for coming in. And if you need me, you know how to get in touch with me. Take care.